If you want to contribute to the Roth IRA, but you're just barely under the Roth IRA income limits as a single individual, let's say $150,000 would be the single, and then $236,000 for the married couples. That's the modified adjusted gross income. So your adjusted gross income is your gross earnings minus your above the line deductions, right? And the HSA and 401k contributions can be deducted from the gross earnings to lower AGI. So what happens is, what you can do, let's say you're single. I'm going to choose single. Okay. Let's say your modified adjusted gross income, $170,000. Okay. And you are a single individual, unmarried, no kids, but you want to contribute to a Roth IRA. So here's the method number one. You can contribute to the traditional TSP to lower your adjustable gross income. So if you want to contribute all 23,000 into it, right? So if you do 170 minus 23, it will be 147,000. So you're going to be under the Roth IRA income limit. So remember that Roth IRA phase out range is going to start at 150 to 165. Okay. So if you lower your income to 150, then you can directly contribute to the Roth IRA at $7,000. And that's going to be the same contribution limit for 2025. There's a downside of doing that because now you're putting your money into the traditional portion. If your goal is to put money into to Roth, right? For your marginal tax rate, if you look at it here, 2025 marginal tax rates, 170,000, you're still going to be in a 24% marginal tax rate. So you're not hitting that 32% as a single individual. So that could be kind of like, should I put money into the traditional TSP so that I can directly contribute to the Roth IRA? The other option that you can do is the backdoor Roth IRA, and it's not as easy as you think it is, but if you understand how it works, it becomes easier for you, year by year. So bear with me here, okay? If your income is over $146,000, or let's just call it $160,000, right? Then you can do what's called non-deductible contribution from your checking account to your traditional IRA. So when you move money from traditional IRA to a Roth IRA, that is also a non-deductible contribution. So you're doing what's called an after-tax, and you're doing an after-tax. So because the money that you put into the traditional IRA is greater than $89,000, so that becomes non-deductible contribution. Right? So when you put that money in there, you can just transfer it to the Roth IRA. So it becomes a non-taxable conversion. Okay. So 7,000 for if you're under the age of 50, or $8,000 over the age of 50. And you should also get the IRS form 8606 that indicates that you converted from traditional IRA to Roth IRA, but in after-tax dollars. You have to state that because the government is not supposed to tax you twice on your retirement, and then you can invest in it. Okay. So please keep that in mind, is this after-tax to after-tax contribution. If you have any balance in your traditional IRA, like any pre-tax balance in there, because you roll over your old 401k into your traditional IRA, then I do not recommend doing the backdoor Roth IRA, because you're going to end up paying tax on the conversion that is called pro rata rule. So you're going to end up paying tax on let's say you convert 7,000 in there, but you have an existing $10,000 in your pre-tax money, and that 7,000 is after tax, but 10,000 is in pre-tax. So they call that pro rata, okay, for the 7,000 and 10,000. So if you look at the ratio, 7,000 plus $10,000, okay? So that's a total of 17,000, right? So what do you think is better? Investing $500 a month, making 10% return, or investing $1,000 a month, making a 7% return on investment? You can't figure out how much you can invest without a budget. There's no way around it. I personally tested out the budgeting app called YNAB, and it's not just an app that can track your income and expenses, but it can even help you create a plan to pay down your student loans, car loans, personal loans, or credit cards a lot faster. So if you're ready to change your life by getting out of the paycheck to paycheck cycle, you can get a free trial without any credit card information by using the link in the description below. So if you have $7,000 that you're trying to put it in after tax, and you have a existing $10,000 in pre-tax. So if you look at the rate, you have total of $17,000, okay? That is the total. But what you want to figure out is what is the 7,000 divided by 17,000. So you have 41% of your traditional IRA in after-tax money, and then you have 59% of your traditional IRA in pre-tax money. So this is taxable, okay? Taxable, and this is not taxable. So when you want to move the $7,000 into the Roth IRA, well, the IRS says, well, wait a minute, you have $10,000 in your pre-tax money in your traditional IRA too. Are you going to convert them all? And you're like, I don't want to pay the tax on the $10,000. I want to leave some of that in there. Well, then the IRS says, well, too bad. You're going to have to pay a portion of it because you have an existing balance in there. So the pro rata rule is triggered. Now that's $7,000. Okay. Remember the 41% that I talked about? So you do it times 41%. It's $2,870. It's becoming taxable income. Now, if you do 7,000 minus $2,870 and a $4,130 is taxable income here. Okay, so now this is taxable and this is not taxable. I hope that makes sense. So when you make that conversion, this becomes taxable and this becomes non-taxable. So when you move 7,000 into the Roth IRA, $4,130 of that will become taxable income, and $2,870 out of that 7,000 is not taxable. So if you're at a 24% marginal tax rate, you're going to end up owing $991 in federal income tax. That's just a federal income tax for making a backdoor Roth IRA conversion with an existing traditional IRA balance in pre-tax dollars. So I hope that clears it up. And that's one of the most common mistakes that I have seen. And I don't know how much you guys read your own tax statements or anything like that. Then I look at it and I was like, man, do you realize how much taxes you're paying because you have a balance in your traditional IRA? Now, one last thing I want to mention. The other question I had was, well, what if I put my traditional IRA in Vanguard, but I have $10,000 in traditional IRA with Vanguard, but I have $0 with Schwab in traditional IRA? Doesn't that mean that I don't get hit by the pro rata rule? It doesn't matter. The IRS will say, how much money do you have in your traditional IRA across the board? Okay, so you can't get away with it. So what is the solution to that? The solution is, if you have $10,000 in your traditional IRA and your income limit is above the Roth IRA, and you're like, man, I need to do this back to Roth IRA. Simple. 10,000 in your TIRA, move it back to traditional TSP. You can do that at any time. You can be an active participant right now, and you can move money from any accounts to the TSP. You just can't move money out of the TSP to another plan while you're still actively employed. So if you want to eliminate the pro rata rule, just move that back to the traditional TSP, or you can always make a tax conversion and pay taxes now. It's up to you. I'm not telling you what to do. But if you don't want to pay the taxes now, because the chances of you doing that, the chances are you're already at the 24% marginal tax rate. So you want to, you probably don't want to pay that $991.20 in tax for making that $7,000 conversion, right? So, you have options here. Move it back to the traditional TSP or make the conversion and pay the taxes in full. It's up to you. But I hope that answered some of your questions about the IRA. That question was submitted in advance from the private community. So if you are interested in joining my private community, join me at firesuch.com/community.